Welcome to RCFE Deal Room. I'm Corpus. If you're buying, selling, or investing in residential care facilities for the elderly in California, this channel is designed to help you make smarter decisions and avoid costly mistakes. One of the questions I hear from prospective buyers all the time is, Dale, how much cash do I actually need to buy an RCFE? Most buyers begin by thinking about the down payments, and that makes sense, but the down payment is only part of the equation. You may also need money for closing costs, professional fees, repairs, insurance, payroll, working capital, and the unexpected expenses after the transaction closes. That's where a buyer can technically have enough money to complete the purchase, but still not have enough money to operate the business safely. Today, I want to walk you through the major cash categories every prospective RCFE buyer should consider before making an offer. I'm not going to give you one universal number because every buyer, lender, property, and transaction is different. So instead, I want to help you build a more realistic picture of the total cash you may need. Let's get started. Number one, start with the deal structure. Before asking how much cash you need, you first need to understand what you're buying. Are you purchasing the operating business only? Are you buying the real estate and the business together? Are you buying the business while leasing the property? Will the seller carry part of the financing? Are you bringing in a partner or an investor? Each structure creates a different cash requirement. Because the business alone may involve one type of financing, buying both the business and the real estate may involve another, and leasing the property may reduce the amount needed for the acquisition, but introduce deposits, lease obligations, and other operating costs. So before you calculate your cash requirements, make sure you understand the structure of the transaction. Number two, the down payment is only the beginning. The down payment is usually the first number buyers focus on, but the amount required can vary significantly depending on the lender, the financing program, the strength of the business, the value of the real estate, your experience, your credit profile, your financial strength, and the specific structure of the deal. That's why I encourage buyers to speak with experienced lenders only. Don't wait until you've found the perfect RCFE. A lender can help you understand what financing may be available, what documentation will be required, and what level of cash contribution you should realistically prepare for. The key point is this. Don't assume that having enough for a down payment means you have enough to complete the transaction. Number three, plan for closing and professional costs. RCFE acquisitions often involve more than the purchase price. Depending on the transaction, you may also incur costs for escrow, title, inspections, appraisals, environmental or property report, legal review, accounting review, loan fees, business valuation, licensing support, insurance, and other professional services. Some of these costs may be financed, some may be paid at closing, others may be paid before you even know whether the transaction will move forward. That means you need money available not only for the acquisition, but also for evaluating and completing it properly. Skipping professional guidance to save money can become far more expensive later. Number four, don't forget property repairs and improvements. Even a well-maintained RCFE may need work. The roof may need attention. The HVAC system may be nearing the end of its useful life. The property may still need accessibility improvements, fire safety upgrades, painting, flooring, furniture, equipment, landscaping, or room modifications. Some repairs may be obvious during the tour. Others may only appear during inspections, and some improvements may be part of your own plan for repositioning or improving the facility. Before closing, try to separate these into three categories. What must be completed immediately? What should be completed within the first year? And what would simply be nice to improve later? That helps you avoid spending too much cash too quickly. Number five, working capital is critical. This is where many first-time buyers get into trouble. Working capital is the money available to operate the business after closing. You may need it for payroll, food, utilities, insurance, medical and household supplies, maintenance, transportation, marketing, vendor payments, and unexpected operating expenses. Even if the RCFE currently has residents and revenue, there may be a gap between when expenses are due and when money is collected. You may also experience resident turnover during transition, or an unexpected repair, or additional staffing costs. Your business needs enough financial breathing room to absorb those situations without creating a crisis. Don't spend every available dollar getting the keys. Leave enough cash to run the business responsibly after you own it. Number 6, build a payroll reserve. Payroll is often one of the largest operating expenses in an RCFE, and it doesn't stop just because the ownership changed. Your employees still need to be paid. That means you need to understand the current payroll, staffing schedules, overtime, payroll taxes, benefits, workers' compensation, and whether compensation may need to increase after closing. You should also ask whether any key employees are likely to leave during the transition. If they do, you may need additional recruiting, training, or temporary staffing. A payroll reserve can help protect the residents, the employees, and the business while ownership changes hands. Number 7, prepare for occupancy changes. A facility may be fully occupied when you make the offer, but that doesn't guarantee it will remain full after closing. Residents move out. Families relocate. Residents pass away. Referral patterns shift. These are all normal realities of operating an RCFE. The question is whether your financial plan can handle temporary vacancies. Before buying, consider what happens if the facility loses one resident or two. How long could you continue operating comfortably? How quickly could you replace that revenue? What would your cash flow look like during that period? A realistic cash plan should account for occupancy fluctuations. Don't assume everything will go perfectly. Number 8, budget for the ownership transition. The transition itself may create additional costs. The seller may remain involved for a period of time. There may be consulting or training expenses. You may need licensing professionals, legal documents, accounting setup, new payroll systems, new insurance policies, technology, marketing materials, website update, vendor deposits, or employee retention incentives. The transition from one owner to another is not automatic. It has to be planned, and good transition planning usually requires both time and money. Number 9, maintain an emergency reserve. Every business has surprises. The question isn't whether something unexpected will happen. The question is whether you'll be financially prepared when it does. An emergency reserve may be needed for major repairs, insurance changes, staffing emergencies, regulatory issues, resident vacancies, legal or professional costs, or operating expenses that are higher than expected. The amount of reserve you need will depend on the business, but having no reserve at all is usually a dangerous strategy. A good opportunity can quickly become stressful when every unexpected expense has to be paid with a credit card or emergency loan. And number 10, don't use your maximum approval as your maximum budget. A lender may tell you that you qualify for a certain amount. That doesn't automatically mean you should spend all of it. Your maximum approval and your comfortable investment level may be very different. You still need to consider your personal financial obligations, your available reserves, your experience operating in RCFE, the condition of the property, the stability of the business, and your tolerance for risk. Sometimes the best decision is buying below your minimum, so you have additional capital available to improve the business and handle surprises. The goal isn't to buy the largest RCFE you can possibly finance. The goal is to buy an RCFE you can operate successfully. Now here's the bonus for you. I want to give you a simple exercise I recommend. Create 3 different numbers. Number 1, the cash required to close. Number 2, the cash required to complete immediate repairs and transition work. And number 3, the cash you want remaining as working capital and reserves after closing. Those numbers should not be mixed together. If you need every dollar you have just to complete the acquisition, you may not truly be ready to operate the business. And here is today's deal room tip. Before making an offer, ask your lender, CPA, and acquisition team to help you create a complete sources and uses worksheet. On one side, list every source of money: your cash, loan proceeds, seller financing, partner capital, investor funds. And on the other side, list every use of money: purchase price, closing costs, repairs, professional dues, working capital, payroll reserves, transition costs, emergency funds. If the numbers only work when everything goes perfectly, the deal may be too tight. If I could leave every percent RCFE buyer with one piece of advice, it would be this: don't ask only how much money do I need to buy the RCFE. Ask, how much money do I need to buy it, transition it, and operate it responsibly? Those are three different questions. Closing the transaction is only the beginning. Your real goal is to own a healthy business that can care for residents, support employees, and remain financially stable after the excitement of closing is over. If there's one thing I hope you take away from today's episode, it's this: the cash required to buy an RCFE is much more than the down payment. You need to consider closing costs, professional fees, repairs, transition expenses, working capital, and emergency reserves. Every transaction is different. That's why I encourage buyers to speak with experienced lenders and advisors early, because they become emotionally attached to a particular opportunity. Whether you're buying your first RCFE, growing your portfolio, or preparing a facility for an eventual sale, I hope RCFE Deal Room becomes a trusted resource along the way. Even if you never work with me, I hope these videos help you make better decisions. That's why I created RCFE Deal Room. If you'd like additional educational resources for RCFE buyers, sellers, and investors, visit simplifyseniortransitions.com/RCFE. There you'll find educational videos, tools, and my free RCFE buyer's due diligence checklist to help you navigate the California RCFE market with greater confidence. If you found today's episode helpful, I'd really appreciate it if you subscribe, and I'd love to hear from you. What expense do you think first-time RCFE buyers are most likely to underestimate? Leave your answer in the comments below. I read every comment, and many future episodes are inspired by your questions. Next time, we'll switch back to the owner side and answer another important question: when is the right time to sell your RCFE? Thanks so much for watching. I'm Corpus, and I'll see you next time here on RCFE Deal Room.